Hi Sachin, how are you? Good to see you. हेलो प्रवीण जी, कैसे हैं आप? Okay, so we'll start now. I'm good, Sachin. Hi Senthil. Great, great. Okay, so we'll start now without wasting much of our time. So basically, we'll be talking two things today. As the topic suggests, generating a high return on your investment. So this is the agenda for today's topic, and I'll speak 5 minutes on both the topics, and then we'll take the question and answers. Generally, what happens is that there are times, there are days when the individual stocks in our portfolio goes up by say 5%, 10%. But unfortunately, the same is not reflected in our overall portfolio return. So even though the individual stocks are generating good returns, the same is not translating into or resulting in the overall growth in the portfolio value. So that's a problem that we face more often. And what is the solution basically? So this is what I wanted to talk about. Let's say the our capital is say rupees 1 lakh, and the answer to the earlier question that I asked, what is the solution? It all depends on how you are investing or how you are allocating in any individual stock. So if I ask people like how did you decide to invest say rupees X amount in any particular stock? So people say that okay, if my portfolio value is 1 lakh rupees, I invested say 5,000 or 10,000 in any particular stock. So they go by investing a fixed amount in each particular stock. But in my view, that is not a good way to do, because the risk varies from stock to stock. If you are investing in, let's say, stock ABC, so the risk there might be different as compared with another stock, let's say XYZ. Because your stop loss level must be different, or even if you are investing fundamentally, the risks are different in both the companies. So if the risk is different, how you can invest the same amount? So that's the typical mistake that we all have done, or people still do. So the best way is to how to decide how much you are going to invest is to use a position sizing calculator. First of all, you need to understand, or you need to determine how much loss you're willing to take in every stock. Let's say if I have a capital of rupees 1 lakh, then how much amount I can comfortably lose in any particular stock. And the amount that I'm losing, I'm sure that I would be recovering that amount in the next trade. So what is that amount? That everyone has to decide on their own. So let's say if my capital is 1 lakh rupees, and I'm willing to risk 1% of my capital in each trade. So the risk per trade would be 1,000 rupees, right? Now let's say the entry price of any particular stock is say rupees 100, and I'm exiting at say rupees 90. So which is what 10% risk. So the risk per share in rupees terms, that would be 10 rupees. So if I'm buying one share, I would be risking 10 rupees. So in order to lose 1,000 rupees, remember the risk that we can take per trade is 1,000 rupees, as we calculated over here. So if the stock price is 100, we are willing to sell at 90 rupees. In that case, to fulfill this risk per trade, we'll have to buy 99 shares. So if I are buying 99 shares, the position value would be 99 into where is it, into 100. So that would be 9900, and the risk in this trade would be 990 rupees, which is close to the 1,000 mark, right? So this tells you that if this trade does not go in your favor, you would be losing 990 rupees, and the allocation of your overall portfolio would be 9.90%. So that's pretty good, pretty reasonable. But now here's the problem, that if you are losing 10% in this particular trade, now in order to gain this 10%, the amount that you have lost, which is in order to gain this 990 rupees, you will have to generate more than 11% return in the next trade. Now this is the most tricky part. If your losses are big, you won't be able to generate a very high return on your investment. Now let's do something. Let's say I have invested at 100 and I am willing to exit at, let's say my stop loss is 95 rupees. Now when my stop loss is 95 rupees, my risk reduces to 5 rupees per trade, and my position size that increases to 199. And if this happens, then my risk in this trade still remains at 995, because the amount that we kept maximum loss was at 1000 rupees, so I would still be losing 995 rupees, but my allocation increases to 19.90. So the things that are happening over here, let me put it in a very simple way. So if my stop loss, where is it here? So if my stop loss reduces, my position increases. I mean my position size that increases, and there is a fair chance of, and also my allocation, obviously my allocation increases. And if I am right, then there is a fair chance of generating a higher alpha in this particular trade. Sorry about that, guys. I think there was some network issue. So as I was telling, am I audible, guys? Okay. So as I was telling, the risk per trade. So there are two things that you can do over here. So if you are not comfortable with such a small stop loss, what you can do is you can either play with this risk per trade, or you can tweak your stop loss. So both tweaking both these parameters will give you a better return on your investment. Now let me show you a few examples about what I'm telling. So let's say okay. So this is Electra. Let me get rid of this. So Electra, I think we discussed this stock in the Telegram group, and we also traded. So here we had a very strong momentum, and then price came near the moving average. So all the way over here, we had a very nice low risk entry setups. Now understand, let's say, what is the difference between this trade and what is the difference between this trade. I'll show you. Let's say if I'm buying a stock over here, which is a very legitimate trade. So my entry is let's say at 648, and my stop loss is, let's say, below this low, which is 612. Now let me put it over here, 648 and 612, and oh, here. And the amount that I am willing to lose per trade is 1000 rupees. So this gives so as per the input that I have given, I would be buying 27 shares, right? Now let's take another trade. Maybe, yeah. So let's say if I'm buying here and I'm keeping stop loss below this low, which is 649, and I'm buying at 661. Now there is a sharp increase in the position size. My risk per trade has reduced to 12, and this position size is 82. The allocation is 54%. What was the allocation previously? Allocation was 17% in the earlier case, and now the allocation is 54%. Let's do it side by side in order to get a better picture. 661 and 648, yeah. I think there is something wrong in the, where was that trade? uh, just give me a second. I'm tripping on my example. It was 648 and this was 617. Okay, it's fair. And this was 661, and what was it? I must have done something wrong. Hmm. Okay, forget about it, guys. Let's get rid of this one. So, so the thing is, if we are reducing our stop loss, our allocation can increase considerably. Now the thing is, let's say if you have invested say 40% in any particular stock, and that stock goes up by, let's say, even 5% on any given day, that can have a drastic impact on our overall portfolio return, right? So our objective is to find low risk entry opportunities. Now see, what we have been doing till now is nothing different from what I'm suggesting over here. We are looking at, pullback to MA candidates. We are looking at stocks where there is a strong momentum in the background, and which are pulling near to the moving average. And historically, what I've seen from my trading logs, my risk is somewhere around 4 to 5 or 6%. But what if, now my problem is that my risk per trade, it's pretty low. I can't withstand loss in my portfolio. So my this number, this risk percent, what you're seeing is zero point 0.1. It's 0.45 0.45% for my portfolio. So in that case, what happens is my allocation becomes really small. As a result, my portfolio gets overstretched at sometimes, though it's not happening now. Earlier it used to happen that at one point in time, I used to have around 18 to 20 stocks in my portfolio, overall portfolio. So that was obviously over diversified, and I was not able to beat the market, or even though I was good in stock picking, that was not reflecting in my overall portfolio. So what I did was, the first thing was to reduce your stop loss. So this is what we can do. We can look at low risk entry opportunities, and out of that we can further fine tune it. So we can fine tune it how? So the basic idea, I hope you all are aware with the Bollinger Band concept. So even if you are not aware, let me show you something. Let me explain it. So Bollinger Band is nothing but it plots your upper band and a lower band. Basically it's an envelope, and this is the 20-day moving average, the blue line that you are seeing. And here what we are doing is, we are plotting one standard deviation above this basic line, and one standard deviation below this basic line. So the basic understanding, or the basic usage of Bollinger Band is to identify the sideways phase, and to identify the expansionary phase in the any instrument. Hi Naresh, hi Kuldeep ji, good to see you. Yeah, that's right, Sachin. So I'm using one standard deviation, just because I want to identify very small pockets of consolidation. If I'm using 2 standard deviation, maybe this this phase won't come across as a consolidation. Maybe there is a possibility that this won't come. Or I'll tell you why I'm using 1 standard deviation. So if you'll notice, so Bollinger Band basically, uh, this shows you the expansionary and the volatility, I'm sorry, the contraction phase in any particular instrument. And as you know, volatility is cyclical in nature. This basically captures the volatility. So volatility is cyclical in nature. Any stock that is witnessing an expansion in volatility will at some point in time witness a contraction, which will continue for some time, and again the expansion will happen. It, you know, you can notice this happening across any instrument or any particular stock all across the globe. So this is the basic phenomena which plays out. So the so this is how the nature of this is how is the nature of volatility. It expands, it contracts, it expands, it contracts. So when we know that volatility is, cyclical in nature, so this gives us an advantage that when it is in the contraction phase, we can explore for low risk entry opportunity. Now, so what our objective is to find low risk entry. This is first objective. What we have been doing till now, we have been buying stocks which are in a pullback to identify low risk entry opportunities. Now we will combine all these 3 things. Let me show you how. So this is Electra. Now what I have done is, since we know that volatility is cyclical in nature, so I have done something. Let me slightly increase. Yeah. So the blue color that you are seeing over here is, this is the zone. This is the zone when our Bollinger Band became too very narrow, right? These are the zones where our Bollinger Band became very narrow. Over here it became narrow, and after that we had a fall. Here it became narrow, and then we didn't have much of an expansion. It remained narrow over here, and then it had an expansion in this phase. So, and let me also plot the moving average. So this is our 10 and 20 day exponential moving average. So as per my system, I took an entry somewhere around here. So I think I took an entry over here. So the pullback to moving average gave an entry from here till here. But if we combine Bollinger Band, then we had a buying zone in this particular area. So what I have basically done is, if the stock price is in this particular band and the risk is around 1 or 2%, then it's a green signal, such as this. Here, if you'll consider, your risk is around 2%, right? It's a quite negligible. Again, if you'll consider, okay, it's a, let's say it's a green candle, but ignore that. It's above the moving average Bollinger Band, but again we can consider that. So these are the areas where you'll find risk in a range of not more than 3%. So if your risk is 3%, and if you're willing to lose a big amount, let's say 1%, then your allocation would be in range of 30 to 40%. So which is quite significant, because if that stock goes up by 10%, your overall portfolio might go up by say 5-6%. So imagine doing that 10-12 times a year. So if you can do that, you can compound your money at a really enviable pace. So this is what was about Electra. Let show you defects where we traded. So defects, we entered somewhere around here. The first entry was around here when it was a nice pullback to the MA. But after that I started adding over here. But in the hindsight, this was the best entry. Of course I added over here. But if you plot the Bollinger Band contraction range, this would show you that these are the areas where we had a very low entry opportunity. I mean 1% kind of risk was over here. Here we had a risk of 4%, but the risk was 1% over here. So that is quite considerable when you think of the overall portfolio return. Let's do the calculation once again. I bought over here. My entry was at, let's say, 550, 525, and stop loss was at 503, 525 and 503. So the position size was 19. Let me write it over here. And the same trade, if I take over here, my entry would have been at 518, let's say, and yeah. So now if you can see, the my position size has increased to 29 from 19 earlier, and now I can invest 15,000 in this particular stock as compared with 9,900 which I invested when I invested over here. So the same stock, investing at a different point, you can generate a better return. So this is what we need to keep in mind. Now remember one thing, I'm not telling that you need to ditch your pullback to MA strategy. No, you don't have to do that. You'll have to do what you are doing, what you have been doing till now. But if any stock where you find this kind of formation happening, and which is near the pullback, which is near the moving average, that is a kind of no-brainer stock to go ahead. So this is the basic gist. Let's look at a few stocks where you can find this contraction happening. So I have changed the watch list segment. Now if you'll notice, here we have the script, here we have the 1 day change, here we have the RS score, here is the chart, and here is something contraction. So most of the fields for most of these stocks you'll find it's empty, but there would be certain stocks where you'll find tight range. Say HSCL. Let's look at the chart of HSCL. Okay, so HSCL, so here we had a momentum and the price pull back to the moving average, and this is where the price is near the moving average and the stock is also in the Bollinger Band. Bollinger Band, by Bollinger Band I mean the distance between the upper and narrow range is less than 6%. I forgot to mention this. So the distance between upper band and the narrow band is less than 6%. When this happens, your this area would get colored as blue color, right? You should have asked me. So these are the areas where you can see it's quite narrow and the distance is less than 6%. So that gets marked as blue color, so that it's easy to identify. So the stock is in the 6% band and is below this upper band. So the ideal entry opportunity was over here when the risk was around 2.5%. But we can consider the stock right now also. So these are the ideal candidates. If you ask, it's a pullback to near the moving average. Volatility has contracted, and if we can win, then that would be considerable. That would generate a considerable alpha for our overall portfolio at a very small risk, right? So let's look at a couple of more stocks. This ICICI Prudential, again, see, we had a momentum, the price declined, but we did not had a follow through to this sell signal, which says that maybe this entire sell off is not that significant. Price is in a contraction. The distance between the upper and lower band of the Bollinger Band is less than 6%, and it's the price is well below the Bollinger Band. So if you keep the low of this low as the candle as the stop loss, your risk would be somewhere around 1.5%. Even if you keep below this low, it would be 3%. So these are the stocks. And now imagine if this stock, which is at 579, that goes up to, let's say, if it generates a 10% return on your overall portfolio, so that would be quite good. And the best part is how you can make this trade risk free. If you are risking, let's say, 2% on this particular trade, if the stock generates 6% return, you can sell one third of your quantity and make your trade risk free. I mean, whatever amount that you have risked, you have booked from that particular stock, and as long as the stock is above your break even price, buying price, you are good to go. So this is something that you can explore and keep track of. If you want to, here is something known as contraction, a field as contraction. If you want to choose only stocks which are in a contraction phase, you can remove this null field, and this would give you the list of stocks where RS score is more than 40, and are in stocks are in the contraction phase, right? Ethos is one stock that I like. Again, we had a sell signal over here, but I think that would turn out to be a trap pattern. Here we had a strong buying interest, and right now the price is above the moving average. It's we had a momentum over here, so I think it's a very good investment candidate. It's in my watch list, and I'll explore buying opportunity. I'm using 20-day moving average, Sachin, right? CAT is one stock which is offering very nice entry opportunity. We had a sweet spot over here. Uh, the stock seems to be giving a very nice entry opportunity. Again, if you'll notice this candle, we had a strong buying tail. Can you notice this one? So there is a strong buying tail over here, and the price moved up by 1.3%. So let's say even if this is the market top, even if we are not right, there's nothing much that we can lose from here, isn't it? If our stop loss is 3 to 4%. The problem is, let's say if you are buying a stock over here, the thing is that there is enough momentum built in, and the stock may remain in a sideways phase for a long time, or it can result, it can your stop loss can get triggered very soon if you are buying somewhere around here. So but the same stock can offer a pretty reasonable entry opportunity on later dates when it's in a tightening phase. Is it? Let me see at Ethos. Yeah, on weekly time frame, yeah, looks nice on weekly time frame. It has pulled near the moving average, and it's a very good looking chart, right? So this is what you can do. So basically, three things we need to consider. If you don't have this calculator is pretty simple. You can make it. If you don't have, you can ask me. I'll share the link in the Telegram group. I'll share it anyway. You can modify this particular this parameter, how much risk you are willing to take in any particular trade, and after that the this thing you need to figure out, and lower your stop loss, higher will be your position size, and that can have a dramatic impact on your portfolio return. And by dramatic, ideally mean dramatic. Imagine your portfolio generating return in range of 50 to 60% in 1 month. That kind of return you can generate if you understand or if you can use this, if you are using this tool. It's nothing magical. It's a position sizing calculator. It hasn't been for ages, but generally people don't use. I did not use it for most part of my career. So this is Paras again. If you'll see, we had a strong momentum. Price came near the moving average. It's a nice. There's a considerable shrink in the volatility. Volume has nearly dried up. If you'll see, volume is so very low. Your candles are barely visible, and how much even if you keep your stop loss below this low, your stop loss would be around 3%. So but if you're right, you can make a decent money. Let's say you invested over here, and the stock generated say 13-14% return. So yeah, Naresh, yeah, I will talk about Supriya. Just give me 2-3 minutes. I'll conclude this. So this is what you can do. You can explore this. Uh, there are several stocks. I can keep talking about that. This is Kalyani Jewelers. Again, see, this is a very nice pattern. We had a strong momentum. This was a sweet spot where I had this in my watch list, but I missed investing over here. Um, uh, but after that, the stock gave a very nice rally, and I could have invested here. Again, missed. But again, this stock is offering a good opportunity. Let's see if I can buy with a small stop loss. So on weekends, you can spend some time exploring this. You can look at these stocks. There aren't much stocks if you ask. There are 188 stocks, and you can cover it within 2 to 3 minutes. I mean 30-40 minutes or so. Why one standard deviation? The reason for one standard deviation is because if I'm using two standard deviation, the contraction. If you'll notice, I have used the distance between both the upper band and the lower band should be less than 5%. And if I'm using two standard deviation, it would mean that the envelope that would be bigger, that won't contain this particular move. So when I'm buying for swing trading, so in that case I want even the smallest contraction to get captured. Okay, so but if I'm using two standard deviation, so in that case, until and unless that contraction is meaningful, that would not get contained in that particular envelope in the upper and lower band. What I'm trying to say is, okay, let me do something. I did not give a feature over here. Let me change it. Okay, let's make it 2 and save it. See, so now what happened is that the when I use two standard deviation, the Bollinger Band is not considering this movement as a contraction, because this is meaningful when you have given your standard deviation as 2. But if you consider if you reduce this number to 1, your standard deviation, your Bollinger Band would consider this as a contraction. In fact, if you consider this as 0.75, your charts would change, and that would consider this move also as a contraction. So I want the reason is that I want smallest contraction to get captured when the price is near the moving average, where contraction of 3 or 4 days is happening, so that I don't get lost when I'm using a higher standard deviation. So that's the basic reason. If I want to buy on a, let's say, weekly time frame, or if I'm buying for long term, in that case I would increase my standard deviation, that number. I hope this helps, Kuldeep ji. Any questions you have, you can ask. If not, I will take this Sophia life science question. Okay, let's talk about Sophia. What do you want? I think I made a video regarding Sophia some time back. So, Sophia, I'll talk about this talk, what went into my mind, and what I was thinking. And let's get rid of this moving average and this Bollinger Band. We'll talk about the price just. So the stock, got listed here. It was a fundamentally very strong stock. Everyone was bullish. The stock was commanding a very high valuation over here, and later on, this was January 2022, and they used to supply, some products to China. After that, China got into lockdown, so and they went into lockdown during 2020-22. So when they went into lockdown, the company could not, the Sophia Life Science, they could not supply to China, and as a result, their performance started declining. So their margin contracted, their top line reduced, their obviously the profit also declined, and as a result, price also continued to decline from 600 levels to it came all the way to 160 levels. So so when this kind of price decline happened, valuation also became very reasonable. But the problem was that they were still facing issues in China. Now there is one very interesting thing. Remember, I told you that volatility is cyclical. I know this applies in business world also. Nothing goes on in a similar fashion. There are times when business is doing well. There are times when uh, business goes through a drawdown phase. So so if business is going through a tough times, there will be a time when things would start improving. And if that happens, and if you are able to spot that, you can make a lot of money. So things were bad till here, but I was tracking this stock. As per my initial research, uh, I got a feeling that the worst is over now, and this the business might do well. As for stock, I was not sure, but as valuation was very very attractive over here, so I thought that even if I am wrong, even if the business does not improve in the next 6 8 months or maybe 1 year, then also I am not going to lose much money. So this was a pure fundamental analysis, and so I started buying from these levels, I guess, and eventually I added at FDLU. I added till here, and the stock gave a very nice reversal. And this is when I knew that okay, the worst is over now, and the stock has made a bottom, and tailwinds in market also started, and I started adding from here. So right now what's happening is, so in this entire leg we were making a sequence of lower tops and lower bottoms, but now we have made a bottom here, we made a swing low over here, we made a bottom here, and the stock is now making higher highs also. One high was here, one high was here, and this stock is making this higher high. So this entire consolidation was, I would say, it was a no brainer, because if you'll notice, we had a nice run up over here, and the stock was consolidating, it was not falling much. And meanwhile there was a considerable decline in volumes. The whatever correction or sideways phase was happening, their volume was not much significant, which is a very bullish indication. So uh, and see, we had a sell signal over here, but price reversed again. We had a sell signal here, but there was actually, if you'll notice, there is no, uh, what shall I say, there is no follow through to the sell signal. By follow through, let me tell you what I mean. By follow through means that when a price is going up, there is some consolidation, and if this breakout happens, this, okay, not that line here. So this is a follow through buy signal. Okay, and similarly when the price is going down, you see this kind of consolidation happening, and the next sell signal, that is your follow through sell signal. So here the price went up, it came down, it again went up, it came down, we had some kind of consolidation, and then it again went up. So basically there is an absence of sell signal on the lower side. So this tells you that maybe bears are not in control anymore in this particular stock, and bulls are taking note of this particular stock, they are buying this stock. So this is the basic interpretation. And on the, if you plot the moving average, this is our 10 and 20-day EMA. These moving average have intertwined, and that's looking pretty neat, if you ask me. Uh, the price is contained in the Bollinger Band, and we had a few reasonable or logical entry opportunities over here. Low risk as well, if you want to trade based on the technicals. And on the weekly time frame, let me show you. We had a very very nice pullback to the moving average setup. This, so if a stock is pulling back on the moving average, and the stock is in a sideways phase on a daily time frame, that's a no brainer. I'm telling you, I have seen this happening across multiple stocks. I think now, okay, now I'll forget the examples, because this happens with me all the time. But this is what happens if the stock is pulling back on the on the weekly time frame, and the stock is in a consolidation in a daily time frame. uh, that is a very low risk entry opportunity. I mean, uh, you can literally buy a stock with 1% risk. Imagine doing that. So after that we had a momentum. That news came, that protein one result came. Result was slightly below my expectation, but again, that's fine. I'm sitting on a considerable gain as of now. At this moment, I won't consider adding this stock. I would wait for some kind of consolidation near the moving average. If it comes near the moving average, then I might go ahead and increase my allocation. Else, I would continue holding this stock. So right now it's not the time to add. Okay. As for target that you asked me in the group, my target is 400. That's based on the fundamentals. So based on the last research that I did, there is nothing change in the initial investment rationale. So I would continue with the 400 target. Okay. Does this answer your question, Mr. Naresh? Uh, Others, if you have any questions, you can ask. Else, we can end this session. So this is what I wanted to share over here. What I will do is I'll share a few stocks, a few other stocks in the Telegram group. But again, see, many a times I don't share because it can overwhelm you in the bull market when everyone is making money. If you we kind of get anxious when we see new investment ideas, and we feel that okay, my stock might not do very well, let me switch to the other stock. So we keep on stock hopping, and that's not good. So this is the reason I slightly share a slightly lesser number of stocks in the Telegram group. But it's not like that stocks are not coming. Just visit this watch list segment and uh, you know spend some time. I'm more than sure that if you spend some time every week, I guess 30-40 minutes, uh, your portfolio will do reasonably well. Okay. So shall we end this session now? Yeah, I'm tracking, but don't invest uh, based on my suggestion. I mean, this Amber I was tracking. Amber was in a consolidation since quite some time now. There are interesting developments happening on the fundamental side. Uh, in the hindsight, I should have invested over here, but again, we can't buy all these stocks at a desired level. So I have still not completed the research. Maybe once I'll complete, and if I find a decent upside, I will share the details in the group. But as of now, I'm researching this stock from the high volume stocks. Okay, guys. Thanks for. Oh, that's really nice, Sachin. Thanks for guys. Thanks. I'm fumbling today. Thanks for your time, guys. It was nice seeing you here on Sunday. And if you have any queries, you can always ping me on Telegram, WhatsApp, anywhere. And I'll share some of these charts in the group. Maybe if you like, you can invest, do your research, anything, whatever. For anything that you see over here, be it this position sizing calculator or any indicator, this one, you can always ask me in the group. I'll share the details. So, thanks for attending. Have a good day. Goodbye.